Hello, this is David Mandell. I'm one of the principals of OJM Group, and I appreciate you taking time to listen to and watch this short webinar. As a series, we provide these webinars every month, and hopefully you can let your colleagues know to tune in and watch these when you can. And we continue to come out with new ones, and the one I'm doing today is brand new. So today, what I'm here to talk about are two tax-advantaged asset classes, and we'll see if you're using them both in your planning, and you may need to revisit this, and certainly we're happy to talk with you about that individually at any time. So a couple disclaimer slides before we get started. We're a SEC registered investment firm. We have a insurance and benefits division. We have a consulting division. But information as we provide here in this type of webinar environment should not be construed as legal or tax advice. It is general. It may be suitable for some people, may not be suitable for everyone. And so we encourage you to use these WebExes as well as our books as a exercise in education and in motivating you to speak with us to see if any of these concepts are applicable to your specific situation. As you may know, we've been writing books for almost 20 years for physicians and for business owners. You can see our physician-oriented books here. We also have a number of business books as well, including the one on the bottom right, Fortune Building for business owners and entrepreneurs. And we're happy to get those to you for free. And we have them all in not only hard copy, and we're happy to send you that, but also in Kindle and iPad version. And for any dermatologists who may be listening, we have a new book coming out this quarter. As I record this in May, it should be available in the next month or so, which is Wealth Protection Planning for Dermatologists, which we have written with Dr. David Goldberg, who's a very well-known dermatologist and also an attorney and law professor. So if you're a dermatologist, we'd love to get you a copy of that or any of your colleagues, so feel free to contact us to get any of these books. So now let's get into it. Now, what is a tax-advantaged asset class? Well, the way I'm defining it today for this webinar is we're going to look at two asset classes that minimize taxes for their owners. Pretty simple. It's a tax-advantaged asset class because the assets have tax treatment that is very beneficial and is also consistent for decades under the tax code. So neither of these are sort of new developments, and neither of them are what lay people call loopholes. These are well known in the tax code and have been for decades. They're also not complex, meaning, my background's an attorney, Carol, my partner, CPA background, and certainly we do a lot of tax consulting for our clients. These tools that we're talking about, these asset classes, are really quite straightforward. Certainly there's some elements to them that may, to leverage the tax benefits as much as you can, you need an expert. That is clear. But these aren't complicated transactions, as you'll see. Now, both of these asset classes can be used individually. If I was defining this also to include perhaps corporate planning at a business or practice, we might also say qualified retirement plans or IRAs are tax-advantaged asset classes. And certainly we do other webinars on those, and we're quite familiar with those and set those up for clients all the time. And but today we're going to focus on really just two assets you can own individually that have nothing to do with benefit planning or business or practice. So what is asset class number one? It is real estate. And as you probably recognize, real estate has some tax benefits in our code and has for decades that other assets just don't have. So let's take a look at that at a real high level. First of all, most people when they're buying real estate are getting a loan, whether it's a home mortgage or a mortgage for business property, rental property, etc. Certainly there are cash buyers, but most people are using leverage when they buy property. And that's where the first tax benefit begins, which is your mortgage on a either primary residence as I give the code section here, or even business property, is tax deductible. So instantly it reduces your taxes, it reduces the cost of, the carrying cost of buying real estate, which you cannot do if you get a interest on another type of loan that might be buying a car or a piece of artwork or a closely held business interest or any other asset. Generally, if it's not business related, it's not going to be deductible. But even on a primary residence, you can deduct that mortgage interest. The other key, another key benefit of tax benefit for real estate is depreciation. And you can depreciate property, both normal and accelerated depreciation, against your ordinary income. So it's another way to reduce ordinary income taxes. Both mortgage interest and depreciation have a tremendous opportunity to reduce your ordinary earned income, which is extremely valuable for many of you listening. That's worth 50 cents or more on the dollar. Then, when you sell this asset, so not only getting ordinary income assets, ordinary income benefit when you buy it if you have a mortgage, when you depreciate as you own it, but then when you sell that real estate and you pay capital gains. So right there, getting ordinary income deductions, purchasing along the way with depreciation, but then selling it at the lower capital gains tax rate. That, again, is something you don't find with stocks, bonds, securities, closely held business interests, and all those kind of other assets that you can use to build wealth. But yet we're selling this at capital gains. And even beyond that, with your primary residence, you may pay no tax on a gain, which is really tremendous for a married couple. If you satisfy the rules, you will get $500,000 of exemption from capital gains, and if you're single, $250,000 of capital gains is exempt from taxation. So that's a tremendous benefit there. And then there's another way to sell property and not pay tax, and that is to use a like-kind exchange under IRC Section 1031. Now remember 1031. This is going to come back in a minute. But you can, under the right rules, and this is where you need the right advisors, of course, but you could sell a property that has millions of dollars in gain and then roll that sale proceeds into another piece of property that qualifies under the like-kind exchange 1031 rules, and you won't pay tax on that gain. And so real estate investors often use this to move from one property to another, and there are experts specifically on helping you navigate that transaction because you have to have the right kind of property, it has timing elements to it, et cetera, et cetera. So how do clients, physicians, business owners use real estate? Well, in my experience working with clients for 20 years, over time, most, 95% rough number, will own a home over time. Doesn't mean they all own it today. Some of them have to build up wealth, or some sell and then they're renting in between, et cetera. But I find the vast majority will own a home over time and take advantage of some of those capital gains and mortgage interest rules. Many will own other property and be able to take advantage of the depreciation rules. Again, most properties, most owners are going to use leverage and use that mortgage interest deduction to their benefit. Some use investment property, office real estate, et cetera, through an LLC. Many who have properties, who own it in their own name, especially rental properties, should probably be using LLCs for asset protection planning, but that's another discussion for another time. You can even get some estate tax benefits when using LLCs and making gifts to family members. But I found very few do that, and even fewer than that, use 1031 like-kind exchange rules. They may not be aware of them. They may not be as heavy into real estate to take advantage of them, but certainly those in the real estate business are aware and leverage that like-kind exchange 1031 rules when they can. Now, from a financial point of view, most of our physician and business owner clients, in fact, when it comes to real estate, probably have too much of it on their balance sheet. And it doesn't mean all, and certainly we're not down on real estate, but if I look objectively and I look at the clients who have been financially damaged the most in the last cycle from 2008, et cetera, were the ones who were overextended in real estate, who bought near the top, and many still today have been paying mortgage for the last 7 years, and yet they're still underwater where they were 2008, 2009. Some have now climbed up to be just above water, or at least even, but they paid a lot in interest and carrying costs, property taxes and expenses, etc., just to have the value break even. So we've had clients, unfortunately, down hundreds of thousands, millions of dollars over that period. And of course, the reason they get strapped is because they're using leverage. Now, again, leverage is not necessarily bad. It allows you to buy a home, mortgage, etc. But leverage also allows for bigger bets. So where somebody might have put $200,000 in the market, and when the market went down 40%, they're down 80. They're down 80,000. Now the markets have come back to reach new highs in 2014 and 15. So they may be all the way back plus with profit. But if they put 200,000 into an investment in the market, they put 200,000 in generally in there. When they were down at their worst, they were down 80,000. But a client who uses 200,000 to buy real estate, they may put 200,000 down and get then a mortgage of $1 million. And so that $1.2 million property, if that was down 40%, they're down almost 500,000. So it's 5 times the amount down because they're only putting down 20%. And if they put it down 10%, it could be even more. So the up and downside using leverage in real estate can be very dangerous to clients who aren't properly diversified. And I think the main lesson from the last cycle that most people now hopefully realize is that real estate is really a long-term asset. I've seen 8 years, 10 years, 12 years from experts who say if you're buying a piece of real estate and you want to sell it at a profit, you better be holding that for 8, 10, 12 years. Certainly there are going to be flippers. There are going to be people who can want to turn things around quickly, but you need to weather a storm like this. So even clients who bought in 2007, 2006 at the peaks, they're probably, if not out yet, maybe in the next couple of years, they'll be at a break even. And that would be about 10 years, 10 to 12 years. So you got to have that mindset when you're using real estate. You can use it. It's a great asset. Sometimes you're going to live in it anyway. But if you're looking for long-term growth of that asset, I think you need a long time horizon. I think that's what we've learned. So what's the next tax-favored asset class? Well, that is cash value life insurance. And for decades in our tax code, just like real estate, cash value life insurance has had a tremendous tax advantage. Number one, the cash values, whether they're a whole life policy that grows with dividends, whether they're an index policy that's tied to the S&P or the Dow or some index, whether it's a variable policy that's tied to a bunch of funds, mutual funds that you pick. No matter what that cash value is invested in, under 72E, those cash values grow tax-free. And if managed properly in a non-MEC situation, and you're keeping that policy in the right ratio of the death benefit to cash values, so it maintains its tax benefit, you can take those cash values out against return of capital and also a loan against that death benefit. And these policies often have very, very, very low loan rates. It could be as low as 0%, 1/10 of 1%, etc. Almost wash loans. So you can pull it out tax-free because loans are not taxable. Policies got to stay in place and be in effect. But if you do that, then not only are the cash values growing tax-free, but they can come out and you can access them and spend them tax-free. Also, the death benefits pay out to beneficiaries income tax-free under Section 101 of the code. So not only are you getting tax-free growth, not only are you getting tax-free access of to spend, but you're also, what's left at the end when you die, those death benefits go to beneficiaries tax-free under 101. And very interesting, the one tie between cash value life insurance and real estate, the one common thread which you see in the tax code is that like-kind exchangeability. Now, what we mentioned, 1031 is the tax section that allows real estate to be used at like-kind exchange. 1035 is the code section that allows one to move between two life insurance policies using a like-kind exchange. So I had a variable policy with a large carrier, very well known in my portfolio, for about 8 years, and then around 2012, I believe, I moved that policy, had a lot of built-in growth, from one policy that was variable to another carrier that was an equity index policy. And when I moved from one to the other, even though I had a lot of built-in growth, I didn't have to pay any tax because there was a like-kind exchange between one policy and another. And again, I can do that with life insurance. I can do that with real estate. Can't do that with stocks, bonds, mutual funds, interested, closely held businesses, commodities, artwork, anything else. So it's a good tie. It shows you how these two asset classes are tied some way in the tax code. So how do clients, physicians, business owners use cash value life insurance? I find that the majority, maybe a little over 50%, have this in their portfolio as part of their asset class. Many aren't, and they should be, for the tax benefits we're talking about here, for the investment options inside it, for the asset protection. Again, those are topics for other webinars. But I think even the ones that have the policy, we find that as our insurance team reviews them, few are using optimal policies in terms of product design, in terms of the product itself, in terms of the design and the funding. And that's one of the reasons I exchanged from my variable to my equity indexed. I like the equity indexed growth options much better, and that is something that a lot of clients could look at reviewing. And again, this is even more so because fewer clients take advantage of the 1035 like-kind exchange rules to move to better, more efficient policies. So I think a lot of clients have them. The ones who have them, they could be better optimized, and they can use that like-kind exchange option. And then the ones who don't have it as part of the portfolio, it's probably something they should review and have as some part of their portfolio. Probably not as much as their real estate, but as some small part of their portfolio. So financially, I think most clients could use this kind of asset class in a better way by improving their policy or exchanging it. And for those who don't have it, layer it in. And again, just like real estate, long time horizon yields best results. Cash value life insurance is designed for at least that 10, 12-year time horizon. And ideally, you think of it as what we call LIRP, life insurance as a retirement plan, as part of your retirement planning, which could be more like how you look like a qualified plan or an IRA. You're looking at it for decades in the future and taking advantage of that tax-free growth. Albert Einstein said compounding is one of the eighth wonders of the world. Tax-free compounding is even more powerful. So if you use this type of asset class, like real estate, with the right time horizon, then you're going to get a great value and great tax benefits out of it for long term. The last thing I'll mention is for some larger policies, you have the opportunity to use something called premium financing, which essentially is basically borrowing money to put into this policy and pay the premiums, which is exactly like a mortgage, borrowing money to buy a piece of property. Again, it's got to be financially make sense for the client, and it's got to be in proportion to their overall net worth, and it really is for the larger policy and the larger clients. But again, a lot of people didn't even realize that it could be done, and with the favorable rates we have over the last couple of years, there are clients who are using this asset class very similar to real estate by getting a mortgage and realizing that long-term benefit by using other people's money for part of it. But I think the key is having it as part of your portfolio, the right policy, the right design, the right funding, and long-term focus. So how do we work with physicians and business owners? These are all the different ways. Today I just drilled down to one topic here on really tax diversification is what it would come under. But certainly asset protection is something I'm an expert in. Tax is something Carol's an expert in. Corporate structure, benefit planning, retirement plan, insurances we touched on today. And of course, wealth management. We manage over $300 million for clients across the country, and we'd love to tell you about all the exciting things and tax beneficial things we're doing on the asset management side. For those of you who don't know, we're a pretty unique wealth management firm. We have more than 1,000 clients in 48 states. We're truly national. We've got 4 offices in New York and Cincinnati and Florida and Arizona. So we're spread out pretty well around the country. We have 3 different divisions: the investment division, the insurance and benefits division, and our consulting side. And our consulting side is pretty unique. We can consult with a personal planning, looking at one thing, maybe tax reduction, or looking at multiple areas and becoming sort of the quarterback: asset protection, tax reduction, investing, financial modeling, education funding, insurances, tax reduction. Or we can look at a couple of items in between. Same thing on a business or practice, looking at the businesses, buy, sells, or non-qualified plans, or corporate structure, or captives, or tax reduction, or asset protection. We can look at all of those things as well. Multidisciplinary is crucial because these questions that clients need answers on, typically you want to get the tax perspective and the legal perspective and the financial and the insurance and how it all impacts. And we've got people on our team that have all those different backgrounds: MBAs, CFPs, attorney backgrounds, CPA, et cetera, et cetera. And on the consulting side, when we're working with a business or a medical practice and tax is a part of it and the client qualifies, we can offer our firm commitment, which says that if we can't show you ways to save at least 200% of our fee in terms of tax savings or employee benefit cost savings, we'll refund the fee. And that's pretty unique. I haven't heard of other firms doing that. So in terms of next steps, if you thought this was valuable, certainly if you don't have a copy, if you're a physician for Doctors Only or one of our state books, if you're a business owner and you don't have a copy of Fortune Building for Business Owners and Entrepreneurs, or any of our other books, please contact us. We'll make sure we get you that in hard copy, Kindle, or iPad. You can go to our OJM bookstore and use this code, WEB0515. You'll see a price point, but when you put that code in on checkout, you're going to get it for free. So you can get our books for free. We're always happy to speak with you for free. You can refer us someone that you think might be valuable for us to talk to. We don't charge. You can certainly contact me at mandell@ojmgroup.com or at our phone number. So appreciate you taking the time today, and look for you on other webinars, and hopefully get a chance to speak with many on the phone. Thanks very much.